Gary from Michigan has owned SCHD for 6 years. He loves this fund. It pays him dividends every quarter, like clockwork. He doesn't check it often. He doesn't need to. But on March 24th, Gary opened his brokerage app, and his stomach dropped. His favorite Dividend ETF had just sold almost half its holdings overnight. Valero, gone. Halliburton, gone. Cisco, gone. AbbVie, gone. These stocks were up 80%. They were paying him steady dividends, and SCHD dumped all of them in a single day. So what did SCHD buy instead? A healthcare giant down 48%, one that's facing a federal criminal investigation, and a consulting company down 35%, and a private equity firm off 30%. Gary's first thought? Something is broken. This can't be right. But here's the thing. Nothing was broken. The system did exactly what it was designed to do. And by the end of this video, you'll understand why. You'll know exactly what happens when you put $100,000 into SCHD right after this reconstitution. You'll see the income numbers year by year, all the way out to year 20. And you'll understand why this trade, the one that looks completely wrong, might be the smartest move SCHD has ever made. And the part most people miss, the new stocks coming into the fund have almost double the dividend growth rate of the ones that left. That single fact changes everything about your future income. Stick with me. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. On March 23, 2026, SCHD completed its annual reconstitution. That's the once-a-year event where the underlying index reviews every holding and decides who stays and who goes. Most years, it's a quiet shuffle, maybe 10 or 15 stocks change. This year was nothing like that. This was the biggest reshuffle in SCHD's entire 14-year history. 47 stocks changed. That's nearly half the portfolio. Normal turnover runs about 10 to 15%. This year, 31%. Nearly 1 out of every $3 in the fund moved to a completely different stock in one single trading day. And what happened next surprised almost everyone. What they sold versus what they bought. So now you know how big this trade was, but here's where it gets really interesting. Let's look at exactly what they sold and what they bought, because the details tell the whole story. On the sell side, SCHD dropped stocks that were sitting at multi-year highs. Valero, one of the fund's biggest energy holdings, was up roughly 80% over the past year. Halliburton was up 46%. Oventive was up 32%. Cisco and AbbVie both lost their top 10 spots and got removed entirely. These were big winners, stocks that had been paying generous dividends, and the fund let every one of them go. Why? Because their price gains had pushed their dividend yields below the entry threshold. Think about it this way. When a stock price doubles, the yield gets cut in half, and SCHD's rules are clear. If your yield falls too low, you're out. No exceptions, no matter how well the stock performed. Now look at the buy side. SCHD picked up names that were beaten down hard. UnitedHealth had fallen 48% from its all-time highs. Accenture was down 35%. Era's management was off about 30%. Abbott Laboratories, Procter Gamble, Qualcomm, Comcast, all trading well below their recent peaks. The number that matters most, the incoming stocks averaged a 63% 5-year dividend growth rate. The stocks that got removed? Only 37%. Think about that. The new holdings grow their dividends almost twice as fast. That's not a random shuffle. That's a quality upgrade. A big one. The sector shift tells the same story. Energy dropped from about 20% of the fund down to roughly 13%. Healthcare jumped up over 3 points. Technology gained over 3 points. The materials sector dropped to almost 0. SCHD went from a heavy energy bet to a more balanced, more growth-oriented portfolio. Most people look at this and see confusion. Smart retirees look at this and see a system that sells expensive stocks and buys cheap ones every year automatically, without emotion. But knowing what changed isn't enough. The real question is bigger. What does this actually mean for your income? Let me show you. The $100,000 income map. Let's go back to Gary. After the initial shock wore off, Gary did something smart. Instead of panicking, he decided to run the numbers. He put $100,000 into SCHD on March 24th, the very first trading day after the reconstitution. At the current yield of 3.45%, Gary collects $3,450 in year one. That's about $287 per month, paid quarterly like clockwork. Not bad, but that's just the starting line. Now, here's where dividend growth changes everything, and I really do mean everything. Before the reconstitution, SCHD's estimated forward dividend growth rate was 8.63%. After the reconstitution, analysts estimate it jumped to 9.38%. That sounds like a tiny bump, less than 1 percentage point, but watch what it does to Gary's income over time. In year one, both growth rates produce the same $3,450, but by year 5, the new rate gives Gary $5,400, about $180 more than the old rate. By year 10, it reaches $8,450. And here's where it gets powerful. By year 20, that same $100,000, without adding a single penny, is paying Gary over $20,700 a year. That's a yield on his original cost above 20%. Compare that to the old growth rate. Year 20 would have been around $18,000. The reconstitution upgrade adds roughly $2,700 per year by that point, and over 20 full years, the extra growth adds about $25,000 in total income. Let me say that differently. The stocks SCHD swapped on one single day in March could put an extra $25,000 in Gary's pocket over 2 decades. That's the power of dividend growth compounding. Small differences in growth rate create massive differences in income over time. And here's something worth remembering. People who bought SCHD back at its launch in 2011 now earn a 12.5% yield on their original investment. They didn't do anything special. They just bought and held. Time and patience turned a 3% yield into 12%. Those numbers look incredible, but I'd be doing you a disservice if I didn't talk about the one risk hiding inside this new portfolio, the one most people aren't discussing honestly. But before I get to that, drop a comment right now. Have you bought SCHD since the reconstitution, or are you waiting to see how this plays out? I read every single comment, and I want to know where you stand. The UnitedHealth question. UnitedHealth Group, SCHD's biggest new addition, added at the maximum 4% allocation cap, and it came in carrying some serious baggage. UNH didn't just dip before SCHD bought it, it crashed. The stock fell 48% from its all-time highs, and the reasons aren't pretty. In January 2026, UNH reported a revenue miss and took a nearly $3 billion pre-tax charge. Their group CEO resigned the year before. The Department of Justice opened a criminal investigation into Medicare billing practices. And all of this came after a tragic real-world event that rocked the entire company. That's a lot of bad news for one holding. So why on earth did SCHD buy it? Here's the myth. A lot of people online believe SCHD made a terrible mistake. They think the fund blindly walked into a value trap with its eyes closed. Here's the truth. The methodology didn't ignore those risks. It measured UNH against the exact same 4 quality screens that every single stock must pass: free cash flow relative to debt, return on equity, dividend yield, and 5-year dividend growth. UNH passed all 4. Its 15-year consecutive dividend growth streak is fully intact. Its free cash flow covers the dividend payout comfortably. And SCHD isn't the only smart money buying. Buffett's Berkshire Hathaway purchased roughly 5 million UNH shares around the same period. Wall Street analysts rate it a strong buy. The stock trades at about 15 times forward earnings, near a 10-year low, and its first quarter 2026 earnings actually came in above expectations. But here's the part that should genuinely calm you down. Even in the absolute worst-case scenario, suppose UNH cuts its dividend completely to 0 tomorrow. It's 4% of the portfolio. On Gary's $100,000, that costs about $138 in lost income. That's real money, but it's not retirement-changing money, not even close. The methodology limits the damage by design. No single stock can take down the ship. That's the whole point of owning 100 companies. So UNH is a calculated bet, not a blind one. But the bigger question still remains. Does this kind of mechanical buy-low trade actually work over time? SCHD has been doing this every March for 14 years. Let me show you the scoreboard. Why the machine keeps winning. Last year's reconstitution loaded SCHD with energy stocks at rock-bottom prices. ConocoPhillips became the #1 holding. Halliburton was added. When oil prices surged in early 2026, SCHD outperformed the S&P 500. That buy-low bet paid off in just months. Go back further, the 2022 reconstitution helped SCHD lose only 3.2% that year. The S&P 500 fell 18%. SCHD outperformed nearly 15 points during a full bear market. While many retirees watched their portfolios collapse, SCHD holders actually collected a bigger dividend that year than the year before. Is the method perfect? No, absolutely not. In 2024, SCHD dropped Broadcom right before it surged over 40% on the AI boom. That hurt. That's the cost of rules-based discipline. Sometimes you sell a future winner because the rules say it no longer fits. But here's what the rules have never missed, not once in 14 years. SCHD has raised its dividend every single year since its 2011 launch, through COVID lockdowns, through 40-year high inflation, through 2 bear markets and a banking crisis. 14 straight years of higher income, 0 exceptions. The system doesn't try to predict the market. It doesn't chase what's hot. It doesn't panic when things get ugly. It follows 4 simple rules: sell what's expensive, buy what's cheap, collect the dividends, and repeat every March. SCHD doesn't predict the market. It just buys what's cheap and sells what's expensive every single March. And over 14 years, that patience has never missed a dividend raise. For Gary, and for anyone thinking about putting $100,000 into SCHD right now, that's the real story. It's not about whether UnitedHealth works out. It's not about whether energy rebounds. It's about whether a system that mechanically buys quality at a discount and has done it successfully for 14 straight years keeps doing what it's always done. The math says yes, the track record says yes, and the 2026 reconstitution just gave you the cleanest entry point in years. If someone you know owns SCHD or is thinking about buying it, share this video with them right now. This kind of portfolio change affects real retirement income, and most people have no idea it even happened. Tell me in the comments, what's your SCHD game plan? Are you holding, adding more, or sitting this one out? I want to hear from you. If you're building retirement income and want to stay ahead of changes like this, subscribe to Golden Goals. I cover everything that protects your income and keeps your retirement on track. And next week, I'm breaking down how to build a 3 ETF retirement portfolio that pays you every single month. SCHD is one of the 3. You don't want to miss that one.